All right, good morning, everyone. Welcome to our Vigil Agency Team Zoom, where we get together once a week for some, um, just get together, going over things. And today we're going to cover the F&G Pathsetter IUL. So why do I like the F&G Pathsetter IUL? Well, there's a lot of great reasons for it, and I'm about to show you one of them, right? Let me actually do it from screen two. That way you can see this. So in order to find the information on F&G Pathsetter, you'll go to HQ, go to Sales Tools, right? Go to Carriers and Products, and then scroll down under F&G, and all of the underwriting guides are right here. So when I click on this one, ages 0 to 80. So most of your clients that want a permanent product are going to be able to um, get this right as long as they meet the health benefits. The other thing is, unlike a lot of simplified term or just terms in general, right? Um, a lot of our high dollar term, the minimum you can start off at is 100,000. So the minimum face amount with F&G is 50,000, right? Maximum premium, 500,000 in premium annually, right? If they need to go higher than that, they can. We've had some people on this team write, $40,000, $50,000 APB off of the Pathsetter. They have 5 different rating classes: preferred non-tobacco. And look at this, they can still get preferred non-tobacco if they've not used tobacco in the last 24 months. They can still get non-tobacco if they've used in the last 12 months. And then they can still have a preferred tobacco, so meaning that they use tobacco, but their health is otherwise good, right? And then this one right here, standard 0 to 17. When you can write a child at a standard rate instead of a tobacco rate, and you got some of you guys are probably like, what are you talking about? So there are other carriers that will allow you to insure under 18, right? But they get a juvenile tobacco rate, which is really odd, right? And it's just they have no way to really have table classes and things like that. So they just give them a standard rating on that. But here they get a standard rating, which is great. All right. Exam-free underwriting, 0 to 60. Even if they're over 60, sometimes they can still qualify for no exam, depending on what their paramed says, right? So there's a couple of other things here as well. You can see applicants who are not U.S. citizens or not permanent residents, maximum issue face amount for the exam free underwriting is up to 300,000. But we go up to $1 million on the exam free underwriting from 0 to 60. Most of your guys' clients are from 40 to 60 anyway, right? Once we start getting over that, we're looking at other things anyway. The they have a lower fee rate, so that's one of the things that I like. And then they have two really great interesting crediting index crediting things. So the Barclays is one of them, and then the S&P annual point to point. So this one here. Okay, so all of this is the stuff that you guys can find within the agent guide itself. So there's a couple other things we need to look at. When you guys are running an illustration, you guys have asked before, right? What is option A and what is option B? So option A is a level amount, right? And then option B is an increasing benefit. And then you have some options as well where you can go from A to B over time, so you can keep it level for 10 years. So you can start to build the cash accumulation in the account. And then over time, you can start to increase the death or the face amount or the death benefit of the policy. And then you can also do it the other way. Someone needs a lot of insurance up front. You can start off high, or you can start it off with increasing, and then when they get to a certain level, it'll level off, right? So think of it like an adjustable comp life that other carriers have. You start off at 150,000, and then every year it goes up, a few $1,000s, and then when they get to 500,000, you take the policy as level at that point, or maybe after 10 years of paying premium, right? So there's a lot of cool different things that you can do with the increasing benefits of it. So they have the accelerated benefit for terminal illness. So this is 2 years or less to live, right? And you can accelerate 100% of the death benefit. Accelerated benefit for critical illness, again, may accelerate up to 100% of the policy's death benefit. There are a lot of policies that will not allow you to go up to 100% on a critical illness. This is probably an important one for a lot of people to understand, right? May accelerate up to 25% if they have a chronic illness, right? They can go up to 100%, but there's a lot of things that you get into that. And guys, don't talk about the percentages. Just let them know that they have these types of things because you will never be able to figure out exactly how that's going to work for them. Okay. So even if they have $1 million policy and they have a critical illness, the critical illness may not be deemed so critical that they are able to receive 100%. So that's not our job to determine. That's up to the underwriters and the claims people to understand that. Okay. Let's see what else. The no lapse guarantee. So as long as let's say that you get someone that's real gung ho about paying a lot of money into their policy, right? They're spending like $500 a month on the policy because that's what they want to put into it, but the minimum might be $250 on it. So if they can't make that premium payment for a couple months, right? They can't make the full 500, they can drop the premium down to the minimum basis and it'll keep the policy in force on a no lapse guarantee. So before we go into any illustrations, are there any questions about some of that stuff that we just covered? Go ahead.
It's probably similar to that. The training this morning that you sent out for 9:30 or 9 o'clock or whatever, I jumped on that and they were talking about IULs for children too,
Yep.
and that's kind of because I was like, man, that's gold right there. But he was talking like a baby, you can start them out at $100 a month. By the time they hit 65, they'll have $1.2 million in there. Can you manipulate the time frame on that? So I know it's like, they get 65. Could you adjust that to where they're like, if they're a child, you start them out at, they're a brand new baby, and you want to give them like a trust fund in a sense when they hit 25 or 30 years old. Could you break it down to that, or did it have to be full term like that, retirement age?
Well, so with a minimum of $100 a month, which is 1,200 a year, right? You're looking at $14,400 after 10 or 12 years. So it's the compounding interest that's getting them there that way. Did you
Right.
know that if you were to give an 18-year-old or a newborn baby $10,000, right, in a fund, in an index fund of some sort, it'll get the same return, right? They'll have a
Okay.
million dollars at the age of 65. So however you want to accelerate that timeline, you can. There's a couple caveats with that. One, the parent either has to have the same amount of coverage in place, and if they can't, you have to share why, right? So if they have some sort of illness that's not going to allow them to, then you can ask for an exception. Two, they have to be able to prove financially that it's not going to affect the household. So if you wanted to, let's say you, Harry, wanted to put $1,000 a month into your niece's policy, right? You have to show why, how it's benefiting her, and there's a couple caveats to that. But yeah, I mean it's totally possible. That's how do you think the rich get rich, right?
Yeah,
Um,
yeah. And I was just curious if you could cut that time frame down to where, you say your son, you started it when he was a baby and he turns 25 or 30, and then he walks into $500,000. You know
yep,
what I'm saying?
yep.
Can you manipulate that time, or does it have to be from to
No,
65
yeah, no.
years?
You can definitely manipulate the time, right? It's going to be based on face value of the policy, one,
Okay.
but that's also going to limit the lower face value you have on the policy is also going to limit the maximum amount of money that you can put into it without it becoming a modified endowment contract. And guys,
Gotcha.
a MEC is not a bad word. A lot of people think that a modified endowment contract is a bad phrase or MEC is a bad word. It's not. It's just all in how you build out that structure. Here's the great thing about F&G. You call them and say, "Hey, this is what I want to do." They're going to walk you through the whole process on the illustration. And I love F&G because they will teach you the nitty gritty on everything. Brenda wrote one, I think it was almost 2 years ago at this point. And I mean, they taught her things she never knew about in the policy. all my job is to give you guys the nuts and bolts on it, right? And then and go from there. So, but yeah, that's a great question, Harry. As long as there's an insurable interest, as long as the the policy has a big enough death benefit or face value on it where you can put enough premiums into it in order to do that. And then as long as the person is healthy enough that you're not going to erode the premiums going into it, right? So
Right.
yeah, so yeah, I saw that, Brenda. Yeah, you call, yeah, and they will. And here's the nice thing about them running the illustration, right? If something comes back from that and it shows that the illustration was done by home office, guess what? They have to honor that illustration, right? So, with Caleb's policy, we're increasing. His is an increasing policy. So we've had that one now for his initial one was for we had it for 10 years, and then 3 years ago we rewrote it from the Northwestern Mutual, or sorry, the Farmers Variable Universal Life Policy to the Pathsetter for F&G. And we rolled over all of his cash value as well. So we did a 1035 exchange on that, which was really cool for me, right? Because I got a nice deposit as well. And Caleb will be taken care of for the rest of his life just based on that one policy with the minimum funding going into that. So, um, I recommend if you've got a healthy child, get this policy. Brenda just learned something as well. The Pathsetter IUL is great for kids on the spectrum. And it just depends where they're at on the spectrum as well. Okay. So what's the proper term for it? Someone help me. Um, Moderate to severe autism is probably not going to be approved, but
Fun-
minimal. Go ahead, Brenda.
That's where I was trying to think of it. Functioning is the one that they like.
Yes, high functioning. Yes.
Yeah, functioning or not. Yep.
Yeah. So they're great for those children as well, right? So a lot of times we run into kids who have autism. As long as they're high functioning and it's not affecting their day-to-day living, they'll most likely qualify it for it as well. And a lot of these parents are very interested in getting them coverage. It's I don't know what it is about that particular diagnosis that parents tend to want to plan for the future for them in advance, right? More so than Down syndrome, more so than a couple of the other really debilitating diagnoses that can be out there. So, um, here's the other thing that I found in the information that we have, right? So they have, if you're here, they have the Juvenile Pathsetter IUL agent guide as well. So if you really want to understand how that works, right, for multi-generational planning, guys, that's how the Rockefellers, that's how they continue to operate, right? So everyone gets a policy early on in life and they fund it. And then when they die, the death benefit just funds the trust. So they're able to take money from the trust, and then every time someone dies, the death benefit funds the trust. And then the trust over time is what's paying the premiums on all those policies. So, I mean, it's very convoluted, right? And it's very, I mean, the way that they have it worked out. But if you can become one of those experts that learns how to do that for people, man, you've got yourself a pipeline that will never quit, right? Like that can, one family like that can take care of you for take care of your business for the rest of your agency, for the rest of your career. It's amazing what that does.
So what's the key with that, Michael? Is like getting in with a family. Like I was walking earlier and there was a couple that had a newborn and I just watched that training and I was like, I almost approached them, but I was just like, I just have just enough, like candy in front of a fat kid. I don't know enough about it to really get them in the van.
Yeah, I mean that's a great question, especially um if you don't have a relationship already with those people, right? I mean, and it could just be as simple as a as an introduction. Hey guys, my name's Harry. I'm assuming you guys live in the same neighborhood.
Well, I will cold approach anyone. I used to door knock, so I'm
Yeah.
I'm not shy with that, but I just didn't know how to. I didn't know enough about it to give them enough to kind of give them, build the value in it. All I
Oh
know is
yeah,
like,
yeah,
hey,
I got
got a
you.
new baby, we can, blah, 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 blah. That's kind of because I literally heard it like right in that meeting this morning. And then I was like, I'm going to go walk. And then there it was. And I'm like, okay, let's try this out. I didn't do it, but
Yeah, so that sorry, for that that's perfect actually. So in that case, what I would do is I would just say, "Hey guys, just want to introduce myself. My name's Harry, right? I work in the insurance and financial services sector. One of the things that I do is I help young families in the planning process. And there's nothing for any sort of consultation or anything like that. Not sure if you guys have that set up. You guys probably seem like the people that already have that set up, right? So you're building their ego, and then they say, "Hey, oh no, we don't have that." So you said you don't charge anything for your services? No, we don't charge you absolutely nothing for your services. So if you guys would like to set up a time, here's my information, and then you could just exchange information that way. And that way you have time to come back to it, right?
right.
Talk to them. And if they ask you
Yeah.
questions, be like, we have holistic approach from zero to death, right?
Yeah.
And
Cause
that's
that was like gold nugget out of that meeting. And I was like, man, that is just fire because like I talked to a few people and they're like, well, we can't move, do anything. We're like, we just had a baby. And I'm like, got this.
yep.
So
And,
thanks.
and and the great part is you can get those people started with a $15 a month policy, right?
Oh,
25
wow.
bucks a month. And then you come back to them 3 years later, they have $500 in cash value from putting away 15 bucks a month, right? Be like, "Hey, how would you like to roll this over into an IUL now?" Right? Now you can jumpstart the IUL so the surrender period is lower. You may not say surrender period, but you know what I mean? That way you understand it.
Right.
And it just gives us that freedom and flexibility to help our clients at every stage of the journey, right? Um, so part of Symmetry's thing is protecting you through all of life's journey, right? From birth to death, marriage, graduation, buying a new house, everything in between there, we can help people with. So. And guys, learn this, right? Learn all of the roadmaps that are here. Learn how all the features work for you. And then this part, right, is understanding the ownership and insurability. You have to have that insurable interest. So even if you're an aunt or an uncle, right? So Julia and I are um, guardians for our nieces and nephews in the event that my sister passes away. So that's what's able to get us to be able to insure our nieces and nephews as well. So we have policies on all of our nieces and nephews that we're responsible for, which is all of them. All right. Let me go back to this one. So what I wanted to do is share this as well. Here's the other thing that most people don't know about F&G. They have live webinars all the time. And you get there from here, right? You just click on agent resource site, and that brings you directly here. And I just scroll down. They have so Alexandria, since you're on, right? Look, Spanish, Chinese, Korean, what the indexes do, right? But everything is available in another language. You can choose your language here as well on the living benefits. But they have everything available. This guy's right here. I mean, just the live webinars where they can do a deep dive with you on a specific case, or maybe they're going to be talking about a case that fits what you're already doing, right? Take advantage of them, right? So and then the other thing, guys, is this, right? They have really good opportunities to work with people that are not citizens. One of the few carriers that allows you to have a cash accumulation account within your life insurance. There are so many that do not allow you to do that, right? So, but F&G is one of those ones that does. All right, so here we go. Um, you have your illustrations
Can I
right
ask you
here.
about that?
I'm sorry?
Am I lagging? I'm sorry. I was going to ask you about the citizenship. Do you know what the process is for somebody? I have somebody in Canada that isn't, it's not U.S. citizen, it's not a U.S. citizen.
They're living in Canada?
No, they're living in Las Vegas, Nevada. They have a business. They live here, but they're not a U.S. citizen.
As long as they have a working visa and they can show that they own a home, I think those are the two caveats that F&G requires, is that they have to own
Okay.
a home and that they have to have a working visa at the bare
A
minimum.
work-
Yeah.
Okay. Thank you. Didn't mean to interrupt. Thank you.
Oh, no, you're good. All right. So illustration. So you'll use that under sales tools from F&G, and then we have the actual application. So let's go ahead and look at an illustration. So you would start new case, and it doesn't really matter what you guys want to put here. We'll do Harry, what's your date of birth?
09/26/1983.
Oh, we're the same age, roughly. And what state are you in?
Virginia.
Virginia, that's right. All right, so we'll click the Index Universal Life, and then we'll select the Pathsetter. So a couple things, guys. So like the Execudex and the Everlast, those will be used for other things. For the most part, we're going to stick with the Pathsetter. Execudex is going to be used for businesses that want to do a buy-sell agreement, okay, or an executive benefit for people that have high-value businesses. So you don't feel like you have to be pigeonholed into the Pathsetter, but the Pathsetter is the best because it has the living benefits and it does have the index funds with the Barclays and the Trailblazers. So we'll go. I always run everything at standard non-tobacco, no matter what, unless they are tobacco. But I don't give anyone any preferred or what are the other one? Preferred or the rated, unless I know that they're not healthy, right? So we'll just say that you're looking for a $425,000 policy. Option A, we're keeping it level, right? We're going to leave it the premium as target. So target is means that it's going to be fully funded. And then so here are the two that we use. We use the Morgan Stanley US equity, and then we use the BlackRock Market Advantage 50. So I do a 50-50 split on those two. And it's going to illustrate it at a 619 and a 608. Okay. You can see this one here has a 7.2, but over the last 20 years, it hasn't performed as well as this one has. So that's why I run it that way. And that's the way it defaults at this point now. So it makes it really great. You could add waivers here. I don't add any waivers until I see what the results are going to be. So you'll click on View and Print Illustration. And what'll happen is it'll run its thing. It takes a while sometimes, especially if you're brand new at running illustrations. It takes some of those things in the background to run for you. So, and at 41 years old, 425,000. And I'm looking away from the illustration. I'm going to say that it's going to be about $525. So let's see. Oh, look at that. 519. So $519 a month, a level benefit. Again, we talked about the monthly no lapse guarantee, right? So $259, and that would keep the policy in place to age 56. So you guys remember me talking about that IUL the other day about how the guy thought he had a great policy in IUL? This is what they did. They told him that he could get his, $500,000 IUL at $259 instead of showing him what it really cost, right? But let's look at what this does cash value wise. All right. So you have guaranteed assumptions of 0.025% growth, and then the non-guaranteed is 475, and then here's the one that we were talking about earlier, 614 on the what was that one? The Morgan Stanley. Sorry. So if he's putting in his $6,300 or $6,239 a year after 10 years, he's going to have invested $62,390 into this policy. And you can see here that after 10 years, his account value is only 53,000 and his surrender value is 50,000, but he has a death benefit of 425,000. And it takes a little bit more time. It's right here at the 16-year mark. So it's always after 15 years where the policy breaks even, right? So you can see that the account value and now the surrender value match. So meaning that there's no more surrender value on an IUL. Most IULs will have anywhere from a 9 to a 20-year surrender period. F&G is right around 15 years almost every single time. Okay. So now Harry has been paying on this policy for 20 years. He's put in $124,000, but he has $176,000 available. And we'll just go to 30 years for this one. He's invested $187,000 into this policy, but he now has $428,000. And you can see how the compounding interest really starts to grow in that last 30 years. This is why, guys, this is not a good policy to use for infinite banking. People will tell you all the time, oh, IUL is great for infinite banking. I'm sorry, it's not. People will lie through their teeth just to get a policy sold. You don't want to do that, guys. I promise you. You can come 10 years from now, they can come back and sue you. And 10 years from now, you probably won't have an E&O policy if you're not in the business, right? Imagine getting $1 million lawsuit against you for, misrepresenting how a policy works. They're great. They're great for cash accumulation over time because the compounding interest is what really builds these. And I'm going to give you guys some information here that I don't want it to be taken the wrong way, but an IUL is essentially an annual renewable term policy. Every single year that you have the policy, the cost of insurance goes up. It's not like a 30-year term where you're locking in a flat rate, right? So if Harry is paying what was it, $500 a month on this policy, right? 519. We're just going to say that right now, 120 of that is going to the policy fees, and then the other $400 is going into the cash accumulation, right? But when he's 71 years old, maybe $400 is going to pay for the policy, and 120 is going into the cash accumulation. But why it continues to grow is because you have all that compounding interest over time of the cash accumulation, right? So it makes it very lucrative to sell it as an IBC policy, but do yourself a favor, don't. You can do it as a retirement supplement, and then you can have them run you illustrations showing how money comes out of the policy. So let's just say at 71 years old, Harry now has $428,000 in that policy, right? Well, he doesn't have to pay. He could stop paying on that policy. That death benefit will stay the same, and he can start taking money out of that policy. And if he took $40,000 a year out of that policy, he might be able to withdraw money for 20 years from it because of the interest still accruing year over year. You can do it where you can just take interest only, right? So you can have them calculate what that value is, and whatever the interest grew from one year to the next, you can just live off of that and have whatever your other retirement is, right? So there's a lot of different ways to utilize the cash value in these policies, a lot of different ways to build them. But I just wanted to go over how do we, who's it best for? How much can we get? And then how do we run an illustration? And that was just, like I said, a real basic illustration. You guys can run a $100,000 one, run one on yourself for $100,000 and see where you can go with that, right? Run one up to $1 million on yourself and play with the numbers, or call home office at F&G and have them run some numbers with you. And if now let's say that one of you guys has a career, right? One of you guys is contributing to a 401k and you're overfunding your 401k past the match. Let's say you're putting an extra 250. Well, put that 250 into something like this instead, and man, that's going to be really efficient for you because you take that all tax free, right? All that growth is tax free because what you're doing is you're taking it as a loan. You're not taking it as a withdrawal on your policy. So you saw you get $500,000, right? So if Harry takes a loan of $40,000 out of that, when he dies, they're just going to subtract all of his loans from his death benefit. No taxes. Any questions on that? Go ahead, Chris.
Back to what you said. I bumped into a pair of guys that have they have a business and it's worth a little over six figures. I didn't get an exact amount, but based on what they do. And I brought up the fact of, I'm like, hey, do you have an insurance policy against your partner? Does he have one against you to kind of protect yourselves? And they're like, no, we never thought about that. We have business insurance. I said, what does it cover? They're like, oh, well, the business and liability and all that kind of stuff. So on something like that, that's definitely something that I could pitch to them, right?
Yeah, so the best way to ask that question is, hey, do you guys have a buy-sell agreement in place?
Okay.
So if they understand that, then and then be like, awesome, great. So how do you guys have that funded? And 9 out of 10 people are going to look at you dumbfounded and be like, what do you mean? How do I have it funded? Well, if you pass away, how is your partner going to buy out your other partner, right? Because while you and I might be great partners, Chris, our wives might not stand each other, right?
Yeah.
So, we want the other person to be able to buy out the other person. So you can ask that question, do you have a buy-sell agreement? Half the people are going to say, I don't even know what that is. I've never heard of that, right? And then you can explain what that is. Um, and then if they do have one, how is it funded?
Okay.
It's the same thing. You can ask people if they have a trust, right?
Yeah.
And so many people will tell you, oh yeah, we've got a trust, or we've got what's the other word for it? Losing my train of thought right here. But and then you can ask them, how's that trust funded? Most people are like, oh well, it's not funded. It was just whatever assets we have are going to go into it when I die. That's incorrect, right? You still have to fund a trust. You have
Yeah.
to fund a buy-sell agreement. Yeah. So the IUL guys that we have from F&G is a great one. And I wanted to show you guys how this one works before the new one comes out. The new one that comes out is going to be a lot simpler to write and things like that. But like anything else that's simplified issue, right? You're not going to have the amazing cash growth that you have with like the Pathsetter IUL. And for those of you guys that can qualify for it, I highly recommend you get one for yourself. Seriously, better than a term policy. This is just my professional opinion. You don't have to take it. You don't have to do anything with that. But if you can, it's going to be roughly the same price as a term policy, but instead you're going to get that cash benefit or that cash accumulation benefit from it. So it's better than a Mutual of Omaha TLE, and it's 100% better than a Mutual of Omaha IULE. So what are the
Michael,
questions? Yes, Gloria.
Michael, good morning. Um, I have an IUL on Andres. It's been in place for almost 10 years.
Okay.
Um, he's supposed to have like a good cash value at the end of 18 years. Would it be advisable to look at it and maybe put it into something else?
We can definitely look at a 1035 exchange and see if it makes sense. If it's been around for that long, here's a couple things to think about, right? Has his health changed in the last 10 years? Because when you
No,
replace a policy, you've got that 2-year non-contestability, right? Or not 2-year contestability period.
no, he just has like a learning disability. That's about it.
Okay. Yeah, I mean, let's get an in-force illustration from the current company and we can run a comparison on that.
Okay,
All
sounds
right.
good. Thank you.
You got it. Anyone else?
I do have one more question, by the way.
Yep.
I know I talked the whole time, but you'd mentioned infinite banking. So say I have a home and 2 or 3 car payments, blah blah blah, XYZ. If I was to go refinance everything to bundle all of that and finance it for a larger amount, right? So I have X amount sitting over here. Would I be able to take that extra money, put it into an infinite banking account, and then pull back out of that?
Yes, it's very possible, but you have to be very careful with um how you structure that. You have to show that you'd be able to make that payment first of all to the bank, right? But yes, so there's probably a dozen companies out there that are doing that right now. They do what's called a cash out refi. And what they're doing is they're putting that into but here's the problem that they're doing. They're putting them into IULs rather into participating whole life policies. Yes, that is probably one of the best ways to do an infinite banking policy or a debt-free
That
life policy.
because I was thinking it's like you could do that and then take that large sum. You could still be paying your bills, and you know what I'm saying. You would already have it. It's building interest. You're paying yourself back if you purchase.
So
I was just curious if it was actually good to go like that.
yeah, I want you to research that, Harry, because that is how you can collapse timelines. What do we tell people? We can get you out of debt in 7 to 9 years, right? If you do that on top of doing everything else that you're supposed to do in a debt-free life policy, you can pay off a house in 5 years using the bank's money.
Sweet.
Yeah, dude, I'm glad you brought that up and I didn't have to mention it. I try not to bring that kind of stuff up because we get into the weeds on it, but I love where your head is, right? Because you're thinking outside the box and there's a whole business outside of that, Harry. That's something that you could take, and if you have the right people that can think like that as well, and you can convey that thought to them, and they're open to it. Well, one, you got to have good credit, right? I mean, that's the
Yeah.
one thing. And you got to work with people that have really good credit for that kind of thing. But yeah, it's 100% feasible. How do you think Craig McManaman blew up, guys? No one knows the secret to Craig, right? Craig took a huge equity loan on his house, paid off all of his debt, and funded his agency. He put $20,000 a month into his agency for a year.
I have one more question since we're on this.
Yep.
So I have a dude also that he owns his own business. He's been in business for 5 years and he makes really good money. He runs a shop, But I was talking to him and he was talking about paying cash for a house. And I was like, asking about his 401, his retirement. He's my age, And I was like, there's probably way better options. Would there be a way that he could do like a business loan against his business to do that? Plus, he has a lot of cash on hand, and then tie that into the infinite banking, and then he could just delete. Okay, sweet.
Absolutely. Yep. Yep. I actually just had a friend that did that. He decided that he wanted to go with Northwestern Mutual, unfortunately. And he did exactly that. He took his $700,000, put it into a participating whole life policy with them. And then he bought his house he took the loan from the life insurance. And so now he's paying his mortgage into his life insurance.
Okay.
So that $700,000 is growing with interest, right? And he has a 3.75% interest rate on his mortgage. Like, where in the heck are you going to get a 3.75% interest rate on a mortgage now, right? So yeah, no, completely feasible. All right, guys, anything else? You're muted.
I said my brain hurts.
Oh, yeah, I'm sorry, guys. This was very deep, but we're going to start doing this a little more often because I think it's important that everyone understands how individual products work. And that's my fault. I always assume that people are doing their homework right, but look at all the conversation that came out of this and all the different ideas that came out of it. So, yeah.
No, it's good stuff. It's just, a whole other, like ball game that you start playing with and stuff like that.
Yeah, and that's where it can get scary, right? Because it's like squirrel, shiny new object. And Brenda, don't forget to text your BFF.
I know, it's her birthday.
Yeah. All right. See you guys later. Peace.